Hello, and thank you for tuning in today. For those of you who I have not had the pleasure of meeting, my name is Derek. I'm a real estate broker here in Southeast Michigan for 24 years now. So, as you can imagine, I've been through some different market conditions. For those of you who I do know, it's great to see you again, and I appreciate all of your time today. Before we get started, I wanted to draw your attention to some information here. I have compiled a guide and a checklist that actually go a little bit beyond everything that we're talking tonight. So if you'd like to request that, you can scan the QR code and fill out a little form, or you can text me directly and my information's there. This slide will actually be in the closing of the presentation, so you'll see it a couple times. But I've got some good information, and I'd love to get that in your hands. So wanted to bring that up here before we got started. Whether you're considering a home purchase, a home sale, or you're planning on staying put this year, just looking to inform yourself, you're in the right place. I tried to compile some information where there's a little bit of something for everyone here. And I think that you'll see some eye-opening information. We're going to talk about 2025 market. The national news was a bit disconnected with our local news here, local statistics rather. So you'll see the differences there. We'll take a look at the outlooks for 2026, predictions on values, inventory, sales, that kind of thing. Property taxes and assessments. This is always an important time of year for people who own real estate in Michigan. You'll be getting your assessments in February, and there's some important information there that I wanted to cover and make sure you were looking for. Common mistakes that I'm seeing buyers and sellers making right now, and some good ways to avoid those. What inventory is selling, and what do we think is going to be most appealing to buyers this year? Strategic timing for buying and selling. Again, if you're thinking about buying or selling, we're going to look at some advantageous timelines, depending on which side of the table you're on there, and a homeowner action plan. So let's kind of jump into it here. So if you watch the news at all, the national headlines basically said that the market was frozen or that it was cooling. And there happened to be an average month supply of inventory in the country of about 4.7 months. A balanced market is typically 4 to 6 months. So in recent years, when you heard, somebody's house sold in 2 hours, that's not realistic. That's an artificial market. Nationally, in 2025, we had 4.7 months supply, and we had about 20% inventory increase in some regions, and the national appreciation slowed to just under 2%. But when you take a look at what happened here in our area in Southeast Michigan, the market remained resilient and competitive. We had about 2.7 months supply, so you can see how far removed we were from the 4.7 months nationally. And appreciation in this area, in this region, kind of ranged from about 3 to 10%. There were some areas in Detroit that skyrocketed, so those numbers are skewed a little bit. But the average around here, Oakland, Wayne, Livingston, Western Macomb County, was around 4%, and the median sales price hit record highs. So you can see the disconnect between home to us and what's going on nationally. One of the reasons that we have lacked the inventory that we need and why it's been so competitive to buy a house is what they call the lock-in effect. So homeowners who either purchased or refinanced in recent years and are in the 3% and the low 4%. I know of some people who are even in the 2% on a mortgage. Understandably, they're not all that excited about putting their house up for sale and trading for a house that's priced substantially higher for an interest rate that is double or 2.5 perhaps times what they have now. So that's kept inventory 30 to 50% below a balanced level where it should be. And again, as I stated, payment shock reality, trading a low mortgage payment for what is reality now is a lot to bite off. We have seen the cracks kind of start appearing, however. Life events are forcing moves. The median days on market, now DOM stands for days on market, that's increased to about 34 days locally. But still, if you compare to that nationally, that's at 54 days. you can see how much hotter our market is, I guess, for lack of a better word. The buyer mix shifted dramatically. You can see first-time buyers, and this is kind of a frightening statistic. Nationally, first-time buyers are at their lowest level since they started tracking it in 1981. It was 33%. First-time buyers were 33% of the market back in 2019 before the pandemic, and it's been dropping every year since then. In addition, the average age of a first-time buyer is now up to 40 years old. Years ago, that was 20s, upper 20s, and now that's up to 40. So it'll be very interesting to see how that shifts in the next 5 to 10 years. Cash purchases locally, if you look over to the side there, you'll see that the national average for cash transactions is 26, whereas we're closer to 40. So about 4 in 10 purchases have been cash, which is pretty difficult to compete with. It can be if you're getting a mortgage. So at that 38%, we're among the highest in the nation for amount of percentage of transactions that are all cash. Escrow payments, which includes property taxes and insurance, that jumped 30% nationwide in 2025. And in Florida and Colorado, they spiked over 55%. So there are areas in the country that are really starting to go the other direction. We're not one of them, and I don't envision us being in that ballpark here anytime soon. You may have heard in the news just in the last week or so that the president was looking to ban institutional buyers from coming in and buying homes. That really wouldn't move the needle at all in our market because it's less than 1% of the transactions. We're just really not impacted by that. Also, in the last few days, the White House has announced a plan to let Americans tap into their 401k funds for a home down payment without a penalty. The details on that are supposed to be coming out yet this month. So we'll see what happens with that. I mean, the issue really has been inventory more so than ability for a buyer. So I don't know that that's going to move the needle all that much either. We really have dealt with an artificial market. The period from 20 to 21 was characterized by artificially low mortgage rates, which you can see on these charts. And we're kind of returning to that pre-pandemic healthy market. We reached historically unprecedented levels of around 2.7% on mortgage rates. I don't believe that I'll ever see that again in my lifetime. And it obviously it drove, unique consumer behavior. Existing home month supply, we just touched on that a little bit. We were down to less than 3 months nationally, which is where we are now locally, but you can see how that trend was nationally speaking. So all signs are pointing to we are returning to a normal market. And that brings us to the outlook for 2026, which they've termed the Great Housing Reset. They're calling for existing sales. NAR stands for the National Association of Realtors. They are predicting that the sales are going to go up nationally about 14%, that there's going to be a rise in inventory of about 10%, and that new construction is going to start gaining some ground too. So we really think it's going to be a rebalancing year, which we need. We need to return to that. This slide's pretty interesting, and you can kind of see the experts are a little bit all over the board on this as far as price growth. So the national forecast is to grow between 1% and 4% across most markets. Not surprisingly, that's expected to be a little bit stronger than that here in Southeast Michigan. And that's due to inventory constraints. And we have an affordability advantage. If you go to the coasts, you go to the West Coast, or, you go up into, New York, Connecticut, that area, DC over that way, things are just obviously much more expensive. So you can see these forecasts kind of range from 4.5% all the way down to the National Association of Home Builders actually thinks the values might go backwards up to 1%, and you can see everything in between there. So the balancing act of that is 1 to 4% in the country, and probably around our region 3, 4, 5% just like we experienced in 2025. If you're looking to buy, you'll find this slide informative and maybe helpful. Predictions here in Southeast Michigan. So entry level, that $150,000 to $250,000 house, it's been ultra competitive. It's going to remain ultra competitive. And those homes are probably going to see the highest level of appreciation, 5 to 7%. There's going to be limited inventory, multiple offers expected. No big surprise there. The mid-range, the $250,000 to $500,000, emerging balance conditions with 3 to 4% appreciation. So probably not quite what the lower price homes are going to experience. It's kind of the sweet spot with modest negotiating power and properties sitting 30 to 45 days. Those properties will become more and more negotiable, and I have started to see that. Part of it's the time of year, but I also think part of it is also this shift that I'm kind of discussing. And then the luxury, the over $500,000. This is the most buyer favored market. Not surprisingly, their growth is expected to be a little bit less. A little bit longer market times. So there might be some additional opportunities there for folks who are looking in this area, kind of in that price range. Interest rate trajectory, again, just like the previous slide. If you are looking to possibly purchase a home, you'll like this information. So about a year ago, in January 2025, rates were hovering right around 7%, and now they're closer to 6%. So that's excellent news for people who are looking to secure a mortgage. And the 2026 forecast suggests that 30-year fixed rates will hover between, upper 5s, ideally, to low 6s, mid 6s for most of the year. And some experts are saying they could dip below 6 by Q4. We'll see if that happens. Purchasing power, for every 1% rate drop, 5.5 million more households qualify, which will result in increased demand. So you can see how postponing a purchase and just waiting for rates to come down could cost you money, and I've seen that happen. This graphic here shows a mortgage purchase it's a mortgage purchase application index, and if maybe a little bit tough to read the coloring there, but on the bottom it says historically soft level. The middle, the gray, is historically normal level, and historically strong level. The strong level, not surprising, that was before things crashed. That was when, if you could fog a mirror, you could get a mortgage, stated income mortgages and those types of things. Obviously, a lot of things have changed, but you can see how the mortgage application numbers are trending up. And not surprising with rates coming down and different things that are going on. Some leading things that we are going to watch for in the market this year: the 10-year Treasury yield. When that drops below 4%, you can expect mortgage rates to fall into the upper 5 range, ideally, and that yield is currently hovering just under 4.2%. New listing volume: if weekly new listings exceed 600, and the typical amount is 400 to 500, inventory pressure builds. More choices for buyers. You can understand that will bring prices, that will stabilize prices at a minimum. I'm not going to go so far as to say bring them down, because we're still going to probably have an inventory challenge. But days on market: when days on market exceeds 45 days across segments, the leverage shifts, and we're currently around 34, but that's been trending up. So we're getting more towards a balanced market. And price reductions. Interestingly, over 30% of homes in our area had price drops this past November. Approaching 35 to 40% signals a shift toward a buyer-favored market. So you can see all arrows kind of pointing to the same thing here in Southeast Michigan. These bottom two graphics are from our company, Real Estate One, and they compare the end of 2024 to the end of 2025. You can see sales were pretty flat. Average price was up about 5%, and inventory was still down a little bit. And then I know the graphic on the lower right's a little hard to see, but that teal color graph is kind of what you want to look at, and that shows price reductions. So the price reductions have gone up quite a bit from where they were last year, and last year had gone up from the previous year. So everything's kind of shifting that way. And these just all show more good signs here. We have a low risk for recession this year. Inflation looks like in 2026 that it should be lower than in 2025. GDP, et cetera, all look good. Affordability, that's very important because wage growth is likely going to outpace home price appreciation. That will make for more affordable homes, more affordable payments for home buyers, which is a good thing. That's a good thing for the households, of course. Again, we already kind of touched on probably a bump in sales and prices a little bit. Property taxes. So if you own a home in Michigan, you have been exposed to this. And if you will be buying a home, this is important information for you to see here. So this is a screenshot of part of the Michigan standardized form, and the property assessments for this year will be coming out next month in February. And the way that property taxes work, things in the 90s shifted in Michigan for the good it really ends up protecting property owners. But there are a couple different numbers to be mindful of. There's the SEV, the assessed value, and the taxable value. Which you can kind of see on this chart right here. So I just took some hypothetical numbers, and we're running with an assumption here that this home sold in 2025, and thus it got reassessed, and the taxes are going to change for 2026 and beyond. So what you'll see, if you look at the prior amount year, 2025, the taxable value and the assessed value. If you double an assessed value, it is supposed to somewhat represent the value of the home, the market value of the home. So in this case, you double the 185 and you'd get $370,000. Now, the taxable value is a little bit different. The law that was changed in the 90s protects homeowners from their property taxes racing up. So the taxable value is actually what your property taxes are based off of. And you can see here they're much lower. The taxable value can only go up a certain percentage a year, which we're going to talk about here in a minute. So let's assume that this property sold in 2025 for a sales price of $400,000. Now, these numbers don't always work out perfectly like this, but for this illustration, we're going to pretend that they do. So it sold for $400,000. So now the assessed value and the taxable value are reset to $200,000. And thus the taxes change. Now, I do have a property tax estimator on my website. You'll see that URL right there, and we're actually going to go to that right now, and I'm going to plug these numbers in so you can see real life what that looks like. So if we go to that website, and sorry about that. And let's plug in. Let's just assume that this house is in Novi, Michigan with Novi schools. So you pick the county, and then you pick the municipality, whether it is a city, a village, a township, and the applicable school district. Because believe it or not, depending on what school district a home is in, that will impact the actual millage rate. So for this purpose, we'll say it's in Novi with Novi schools. Now, if we use that prior taxable value of $115,000, we can see that the homesteaded taxes for that particular house as of 2025 let's call it $4,200. Non-homestead, the box to the right of that is if it were a rental home, vacation home, something like that. So the government gives you one. What is your primary residence? You get a principal residence tax exemption on that, whatever is your primary home. So if you had a cottage up north, that would not benefit from that lower tax rate. So let's call this $4,200, and if we change this now to the 200, since it gets reassessed, you can see that 4163 jumps up to 7240. Now that equates to just about $260 a month. So you can see, understandably, if a buyer was not educated on that and wasn't prepared for it, that's not a nice surprise to get in the mail. When I bought my first house 26 plus years ago, I wasn't yet in real estate, and this wasn't explained to me. And I will tell you that was not a fun envelope to get in the mail and open. That my taxes were going up. So this tool exists on my website. It's a wonderful thing. If you're thinking about shopping for a home, you can research different areas, and it's very useful in that regard. So. So going back to this, in this particular example, that home would, taxes could go up in the range of about $260 a month. And then it's capped how much it can go up after that, which is kind of what this talks about. So the uncapping pop-up effect is what we just said, where once ownership changes, then all bets are off. Basically, the government can assess that however they want to. Now, going forward, it can only go up a maximum of 5% a year, or the rate of inflation as deemed by the state of Michigan, whichever of the two is lower. So you can see a couple examples here. One of them is that 400,000, where the taxes actually go up 75%. But if you had an owner and their, taxable value was 150,000, and the market value rose, the taxable value can only go up this year, what is going to be this year, by 2.7%, because that's the rate they determined. If you can see this chart here, it talks about the historical inflation rate multipliers, and it shows you every year going back to 1995 what the inflation rate was. And only twice going back to 95 has it been capped at the 5%. And oddly enough, it was in 2023 and 2024. Otherwise, it would have gone up nearly 8% in 23 and a little bit over 5% in 24. So that law has done some good. When do you appeal your assessment? So on that particular form, it talks about the March Board of Review meetings. And those would be applicable if you feel like you are overtaxed. So if that taxable value number, if you double the taxable value number and you feel that your house is not worth that amount, then you may have grounds for an appeal. And if you would like some input on that, please let me know, as I'd be happy to review your situation. But here's some rules of thumb for when to appeal your assessment and when not to. So the stuff that works: recent appraisal. An appraisal from a state licensed appraiser is always great. If you purchased a home in 2025, for instance, you probably have that. If you did a refi, you probably have that as well. Comps from an assessor or a real estate agent can pull that information together for you. Photos documenting any condition issues or repair estimates. Things that don't work: going in front of the board. If you just say your taxes are too high, or you overpaid for the house, or your uncle said this, or your neighbor pays less, or your estimate is a certain number. Those things typically won't fly. You need substantive proof that your taxes are inflated. I assess my clients with this at no cost. So as a reminder, reach out to me if you have questions about that, and I'd be happy to look into your situation. The March Board of Review begins on March 9th, and depending on what municipality you're in, on the bottom of that form, it will tell you when the meetings are, and there's a process for you to get on the agenda, and you have 10 minutes to give your side of the story and provide documentation. Then in the mail, you will receive their verdict. If you are not satisfied with that, you can take it one step further and go to the Michigan Tax Tribunal, and that's in Lansing. And so there are some additional requirements for that. So that's that process of appealing your taxes. Top seller mistakes that I'm seeing in 2026: aspirational pricing. So you saw the charts when we started, 20 or so minutes ago. Pricing a house now based on the craziness in 2021 and 2022 is just not flying with buyers. Overpricing by even 3% can lead to an extra 30 days on the market. So, for a $400,000 house, if you miss the mark by, 10, 12, 15 grand, that could actually end up costing you a lot more money in the end. Ignoring presentation. Buyers now, I will say, more than ever, want a turnkey house. So doing a light refresh can end up putting a lot of money in your pocket. And we'll go through a couple examples here in a second. Showing inflexibility. I know lives are very demanding, schedules are demanding, work from home. Showing inflexibility can be tough, because as tough as it is in your household, the folks who want to come through your house, it could be equally tough in their household. So telling them no might end up costing you a good offer, restricting showings. Refusing concessions, not offering buy downs, repair credits, or price adjustments, especially after an inspection. If there are some reasonable requests, more often than not, it's wise to have a meeting of the minds with the buyer, find some common ground, and get to the closing table. Disclosure failures, nobody wants to do that. You don't want to not disclose things that you know about. And some people don't realize this, but if you've shared with your neighbor different issues that you've had with your house, and for some reason they don't make their way to the disclosure, and after the transaction, the new owner gets talking to the neighbor, things could go sideways there. So disclose. This is a really good takeaway here: not keeping current with house needs and deferred maintenance. I always tell my clients that a good rule of thumb is that on average, you should be investing between 1% and 2% of the home's value into it each year. So let's say, for instance, you buy a $400,000 house and you invest a 1.5% a year. And let's add 6% a year for inflation and appreciation and that kind of thing. Over 10 years, that would mean you have invested about $80,000 into that particular house. Now imagine if over those 10 years you've done nothing, and then you're going to sell. Well, buyers are going to penalize you for that, for not doing that work that now needs to happen. So I encourage everyone to keep up with those projects over the years. Top buyer mistakes that we've seen and are seeing: rate wait trap, waiting for rates to get back down to 3 to 4%. Again, I don't think it's going to happen, certainly in my lifetime. And understandably, history shows that significant rate drops typically will trigger price surges due to increased competition, and that will erase any interest savings. So as rates go down, your buyer competition goes up. Waiving inspections, skipping inspections, especially on older homes, that's a very dangerous thing to do. And I have forever discouraged my clients from doing that. There are creative ways you can go about having an inspection, and perhaps you cap your requests at a certain dollar amount. That still protects you while you can still, inform yourself on the house and what needs to be done. But waiving an inspection can be very reckless. Escrow shock, just like we talked about, for instance, on taxes, if buyers are not educated on what their new payment ultimately is going to look like and what the costs are. So again, budgeting based on the seller's tax bill and then dealing with that uncapping, and now you have a few $100s more a month, for instance. And insurance premiums are projected to spike pretty substantially. So getting an insurance quote, just like you probably would on a car before you buy a car, that's not a bad idea at all. What's selling in 2026? The turnkey homes. The buyers, again, heavily favor move-in ready homes to avoid high renovation costs and financing. And some are starting to lean towards new construction. And buyers are capturing about 16% of the market share with buy downs and different things. So now more than ever, a buyer does not want to inherit projects that should have been done. Some ROI improvements, especially in our region in the Midwest. Things you might not necessarily think about, like garage doors and steel entry doors. Minor remodels on kitchens and bathrooms can oftentimes be done pretty inexpensively. For years, we would go in and recommend to a seller if your motivation is return on investment and you want the biggest sales price, if we do these handful of projects, you're probably going to get about a 200% ROI. And I know the picture here is kind of funny, but the takeaway is, like in this case, some new flooring, some new countertops, like the painted cabinets, different things. There's different levels, but your real estate expert should be able to break down for you, if we did this project, what would that translate to in sales price? So buyers definitely want to see that right now. When to list and when to buy in 2026. This typically applies most years. Real estate is very cyclic, and this more often than not is how things pan out. So the slowest period we're in right now, the first quarter, it's the best for negotiating leverage for buyers. And some sellers may be more likely to negotiate. Our spring surge is coming April to June. That's when 40% of the transactions in a year typically happen. Bidding wars, and we've seen this in the last 4 years or so. It's been pretty tremendous. Pent-up demand hits. Q3, peak inventory, the summer slowdown kind of starts, buyer leverage increases, price reductions, longer days on market, not uncommon at all. And then we get into the holiday quarter, cooling down, motivated sellers, opportunity for aggressive negotiation. We really see days on market typically extend there, and price reductions. What to do in 2026, even if you're not moving. These are some good recommendations. Do a review on your insurance. Just like I mentioned a couple of slides ago, insurance costs are supposed to go up. But because of how much prices and values have gone up, make sure your replacement cost matches your current values. Many homeowners right now are actually underinsured. If you have been paying, PMI stands for private mortgage insurance. That applies if you have initially purchased a home with less than 20% down. If your equity has reached 20%, request a new appraisal, get a hold of your lender to eliminate that costly insurance. Energy audit, high ROI improvements, attic insulation, heat pump systems, and the things that we talked about before, just doing some minor cosmetic things. You want to keep up on that, 1 to 2% a year to make sure that don't find yourself in a very uncomfortable place when you do decide to sell because of all the deferred maintenance. Again, if you have a furnace that's on its last leg, your roof is 20 years old and really looking sad, you want to catch that before it starts leaking, those types of things. HELOC strategy, you want to be careful with this one, but you could tap into perhaps some equity for repairs, debt consolidation if need be, without losing your low primary rate. Again, I would use caution on what you do there, but if that money is going to be smartly invested into some much needed projects, it could pay off for you in the end for sure. So that concludes our presentation. And back to this slide that I kind of started with, I do have some checklists and some guides that I would love to get in your hands. You can email me, text me, or scan that QR code and fill that out, and I will personally be sending those to you. So thank you. Thank you for spending a half hour or so with me today. I hope there were some good takeaways here. As always, if you have questions about this, your specific situation, your house value, anything along those lines, please reach out to me. It would be my pleasure to take a look and help you out. Thank you.